Hello and welcome. In this presentation, we're going to dive into one of the most practical applications of managerial accounting, decision making. We will be discussing the art of relevant costing, which is the crucial skill of focusing on what truly matters to make smarter, more profitable business choices. Our agenda today will equip you with a complete decision-making toolkit. We'll start by defining the key concepts that form the essential vocabulary for any decision analysis. Then, we'll walk through two case studies. The first is a simple choice involving a decision to rent a new machine. The second is a more complex and common business decision, whether to keep or drop a product line. Through this second case, we'll highlight the critical distinction between avoidable, unavoidable, and sunk costs. Finally, we'll look at how these concepts are applied in the real world by major companies. To make intelligent decisions, we need a consistent framework. Every decision you'll face as a manager involves a few core concepts. First, key concept number one is to always define your alternatives. You must clearly lay out your choices, such as whether to make a component or buy it, or to keep a product line or drop it. Second, key concept number two, you must isolate the relevant costs and benefits. To be efficient and effective, you need to ignore the irrelevant data and focus only on what truly matters to the decision at hand. This leads us to key concept number three, the use of differential analysis. The key to effective decision-making is to focus only on the future costs and benefits that will differ between your alternatives. Everything else is just noise and should be ignored. And finally, key concept number four is to always ignore sunk costs. A sunk cost is a cost that has already been incurred and cannot be changed, regardless of what you decide to do in the future. It is always irrelevant to your decision. For example, the price you paid for a truck several years ago has no bearing on the decision today to keep or sell that truck. Let's apply these concepts to our first case study. Oak Harbor Woodworks is considering renting a new labor-saving machine for $3,000 per year. Let's analyze this decision using two different approaches. Approach one is the total cost approach. As you can see in the first two columns of the exhibit, this approach compares the full income statements for both alternatives, with the new machine and without it. It works, and it shows a clear $12,000 financial advantage to renting the machine, as net operating income increases from $18,000 to $30,000. The problem with this approach, however, is that it's cluttered with irrelevant data. Notice that the sales revenue, direct materials costs, and variable overhead costs are the same in both columns. They don't change and are therefore irrelevant to the decision. Now look at approach two, the differential or relevant cost approach. This method focuses only on the costs and benefits that change. Here, we see a decrease in direct labor costs of $15,000 and an increase in fixed expenses for the rental of $3,000. We arrive at the exact same $12,000 advantage, but we do so much more quickly and with much greater clarity by ignoring the irrelevant noise. That first case was fairly straightforward, but now let's move to a more complex choice. Discount Drug Company is considering dropping its housewares product line, and as you can see from their segmented income statement, the line appears to be showing a net operating loss of $8,000. This leads to an obvious question. Based on this report, dropping the line seems like a good idea, doesn't it? This, however, is a classic trap. The problem is that this report includes allocated fixed expenses, costs that may not actually disappear if the product line is eliminated. To make the right choice, we have to perform a much deeper analysis. The critical question we have to ask is, What costs will actually go away if we drop the housewares line? The key to a keep or drop decision is to compare the contribution margin we would lose to the fixed costs that are truly avoidable. Let's analyze the $28,000 in fixed expenses that have been allocated to the housewares division. First, we identify the avoidable costs, which total $15,000. These are costs that would disappear if the line is dropped. They include the salaries of the employees working directly on housewares, the advertising specific to that product line, and the insurance carried on the housewares inventory. Next, we identify the unavoidable or irrelevant costs, which total $13,000. These are costs that will remain even if the housewares line is eliminated. They include company-wide costs like utilities and rent, depreciation on fixtures, which is a sunk cost, and general administrative expenses, which are a common cost. Now that we've separated the relevant costs, we can make an informed decision by comparing the loss margin to the saved costs. If the housewares line is dropped, the company loses its contribution margin of $20,000. Our analysis just showed that only $15,000 of fixed costs would actually disappear. The financial impact is therefore a $20,000 loss in contribution margin offset by only $15,000 in cost savings, resulting in a net financial disadvantage of $5,000. The conclusion is clear. Dropping the housewares line would actually decrease the company's overall profit by $5,000. Despite what the initial report showed, the housewares line is helping to cover the company's common costs, and they should absolutely keep the product line. This type of analysis isn't just a textbook exercise, it's exactly how major companies make critical and sometimes massive business decisions. Consider the drop a product line decision. After years of heavy losses, LG made the difficult choice to drop its entire smartphone business to focus its resources on more profitable segments like electric vehicle components. Or the make or buy decision. Luxury goods maker LVMH had to perform a differential analysis to decide whether it was better to invest hundreds of millions in its own new facilities to make or to find better suppliers to buy. And this happens at the micro level too. Think about the process or dispose decision. When you return an item to a retailer like Amazon or Walmart, they use a differential analysis to determine if it's cheaper to restock and resell that item, which can cost between $10 and $20, or if it's more profitable to simply let you keep it and issue a refund. For bulky or inexpensive items, doing nothing is often the better financial choice. Let's summarize the decision-making framework we've developed. First, always focus on what differs. The only costs and benefits that matter are those that change between your alternatives. Everything else is just noise and should be ignored. Second, sunk costs are always irrelevant. Forget what you've already spent. It cannot be changed and has no impact on your future outcomes. Third, beware of allocated fixed costs. For keep or drop decisions, don't be fooled by an apparent loss on a segmented income statement. The real analysis always compares the lost contribution margin to the truly avoidable fixed costs. And finally, don't forget opportunity costs. Always consider the potential benefit that you are giving up when you select one alternative over another.